Part 1, Chapter 10, we're going to go over acquisition of PP&E, property, plant, and equipment, and what costs are capitalized. Those are costs that we treat as part of the asset. Now, property, plant, and equipment, the definition is, it includes all items acquired for use in operations and not for resale. They are long-term. That means their use is more than 1 year and are expensed through depreciation, excluding land. They possess physical substance, and they include all costs associated with getting it ready for its intended use. Now we're going to walk through some examples. All right, and what I'm going to do is tell you what the rule is under GAAP, and then show you how to work. And then if I have some cases involving IGAAP, we'll include that too. Now, land capitalized. What do we include? Of course, we include the cost, the closing costs, the legal fees, assumption of any liens, property taxes, or encumbrances. Does not include normal property tax. Now remember, this is part of that rule. We must include all costs that are required to get it ready for its intended use. Title search and title insurance. Any costs associated with getting it ready for its intended purpose include demolition of any existing structures, less any amount received for salvage, any improvements that have an indefinite life, and clearing and grading costs. So an example might be is if you put in some trees, those usually have indefinite lives, you include those as cost of the building. However, if you put in fences and pavement, that would be categorized separately as land improvements, and you could depreciate those because they have a useful life. Also includes clearing and grading. So now we're going to look at an example to see how we would categorize our costs that would be capitalized. Now, here's what we have. We have repairs, construction of new base for some equipment, installed driveway and parking lots, remodeled building including walls, and special assessment by the city on the land of $18,000. So, how do we determine where it goes? Well, first of all, repair on the building would be part of the building. Construction of a base for the equipment would be part of the equipment. Installed driveway and parking lots, that would be land improvements. Remodel building including walls, that would be part of the building, and special assessment by the city on the land would go to land. Step 2, determine the journal entries. Well, we would debit all of our asset accounts and credit cash. Now we're going to look at another example, and this is what's called a lump sum purchase. This is when you pay a one amount for multiple assets. So, valuation of these assets differs when each asset is indistinguishable. Now, if that happens, you're just going to take the total cost and divide by the number of assets. It would be like if you bought a bunch of trucks that are exactly the same. You do it for that. Now, in most cases, the assets have different characteristics and different useful lives and value. Those, we're going to allocate the lump sum acquisition price among the separated items based on the percentage of fair value. So let's take a look at an example. We purchased 2 buildings and 4 acres of land for $900,000. The fair value of building A is $450,000. Building 2 is $250,000 and the land is $300,000. Now we're going to determine the amount to be allocated. This is the kind of schedule you do. You would take the fair market value and you divide by the total fair market value, which gives you a percentage. You're going to take that percentage and make sure it equals 100%. You're going to take that percentage of each of the different items times the amount that was paid, the $900,000, which tells you, for example, for building A, of the $900,000, we're going to allocate $405,000 for building A. Now remember, that's the most we can allocate. So when we do our journal entries, we want to make sure that our total equals the amount we paid, $900,000. Now, what if they had purchased the land and demolished the building? Everything would go to land. That's how it works. All right, now what we're going to do is look at some partial and non-cash acquisitions. Companies can also acquire assets with paying some or no cash at the time of the purchase. Example would be deferred payments like a notes payable, issuance of equity stock, that's very common for startup ventures, or you can have assets donated. A lot of times this will be done by the city and encourage a company to relocate there. And then exchanges of non-monetary assets for other assets. That we'll cover in part 2, but so you know what that means. It's like if you have an old truck, you trade it in for a new truck. Assets acquired in non-cash transactions are valued at the fair value of the asset given or the fair value of the asset received, whichever is more clearly evident. So now let's look at some examples. So, we purchased a truck, we paid $16,000 down and signed a non-interest-bearing note due in 3 years for $70,000. The interest rate of 7% reflects the time value of money for this loan. What is the journal entry at the time of the purchase, the interest expense using the effective rate method for 3 years, and the liability for each year? So, first we've got to go to our present value table. So, we know that we have a single payment at the end of 3 periods, so we're going to go to the present value table. N equals 3, I equals 7. We get a factor of 0.8163 times our 70,000, and that tells us the present value of this note. The difference, of course, is going to be interest expense. So, cash is 16, notes payable is 70. Equipment is 77, which is the $57,141 plus the $16,000 down, and the difference is going to be discount on notes payable. And what we're going to do is allocate that as interest expense over the next 3 years. So now we'll look at the journal entries. So, accrual of interest at the end of the first year, we're going to take the book value, the net book value of the note, minus the discount times the rate, and that tells us $4,000, and the discount on the note would be reduced by $4,000. The next year, the interest expense is going to be the $70,000 minus the $12,859, which was decreased by $4,000 from the previous year, times the interest rate tells us our interest expense is going to be $42.80. Now, what is the balance in notes payable at the end of the year? You have the note less the discount, net book value at signing, and then, of course, what we've done is reduce the discount each year. And then at the end of the third year, the net book value is going to be the amount owed, which is the notes payable. Now let's take a look at the journal entry. Now, here's what we have for the last year's interest expense. We started with $12,859. What we need to do by the end of the third year is eliminate the discount on note by booking interest expense. And then the last thing we're going to do is pay off our note. Now our next example is what happens if we exchange with stock. Rule is, if the stock is widely traded, use the fair value of the stock. If it is not, use the fair value of what is known. So our example is Company A issued 1,000 shares of its $1 par stock, but it is not widely traded for a $20,000 piece of equipment. We have to value the equipment at $20,000 since the stock is not widely traded, and then we would book the stock in this way. Now what happens instead if the stock is widely traded and has a fair market value of $25? The equipment now would be for $25,000. The common stock would be still $1,000, and the difference goes, of course, to additional paid-in capital. Now what happens if we have donated assets? Okay, the rule is donated assets are booked at fair market value and treated as revenue for GAAP. But under the IFRS, the donated revenue is treated as deferred revenue and allocated over the life of the asset. So, the City of Pebble Beach gives Mike a $5 million grant that represents 50% of the cost of equipment that will be used to improve roads in the local area. So, under GAAP, we'd book the cash and book the revenue. And then, of course, we'd purchase the equipment. Under the international standard, we'd book the cash, defer the revenue, and of course then book the equipment. Now, the next thing we're going to talk about is goodwill. Now, we cover this a lot in advanced accounting. Now, goodwill. Because goodwill can't be separated from a company, it's not possible for a buyer to acquire it without only acquiring the whole company or a portion of it. So, capitalized cost of goodwill is the fair value of the consideration given in exchange for the company, the acquisition price, minus the fair value of the identifiable net assets acquired. So, what we're doing is subtracting these, and that's how we're going to get goodwill. So now let's take a look at an example. Now, I want you to also know that they're thinking of, no, they're not, actually for this example, they're not changing, but they are changing how we judge goodwill over time. And that we'll cover in a different section. All right. Goodwill is created when the purchase price exceeds the fair market value of what is received. So here's our example. What we paid $11 million cash for a company, and these are the book values, and these are the fair market values. And first thing we need to do is look at the net book value. So of course, what's the net book value? We're going to take our total assets, subtract our liabilities, and we have a net book value. Now, in order for us to identify goodwill, what we're going to do is we're going to compare what we paid for it minus the fair market value of what we received. Now, here's what's going to happen. We don't cover this here, but you cover in advanced accounting. What we're going to do is we're going to mark up the assets to their fair market value in what we purchased. So that's where those costs will go. And it's only the difference that goes to goodwill. And that ends this presentation, part 1, for Chapter 10. Thank you.